The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. In today's episode, we're going to be continuing our series on entity types by discussing S corporations. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you.
To start us off, just a little note on important upcoming dates. Nothing major right now, but make sure if you need to get your beneficial ownership information reporting done by the end of the year. And it's a good time to keep working on your tax planning, estimates and and are there any tax planning decisions you need to make before the end of the year before it's too late and the time has passed and you can't make a decision anymore.
Yep.
So, Spencer, go ahead and start us off. What is an S Corp?
Yeah, so today, we're talking about S Corps. We recently just talked about partnerships, so if you haven't heard that one, you can listen to that before this one. They are somewhat similar in the fact that they're both flow-through entities, but S Corps can actually be quite different than partnerships on a number of things, and that's pretty much what we're going to be talking about today. So what is an S Corp? Per the IRS, this is what they have on their website. It says, quote, S corporations are corporations that elect to pass corporate income, losses, deductions, and credits through to their shareholders for federal tax purposes. And so essentially, corp is just short for corporation. So it's a type of corporation that is a flow-through entity, right? So normally corporations are not flow-through entities. They're taxed essentially on their own. They're their own entity.
Yes.
But for S corps, they are flow-through. So they flow through their income, and we'll kind of talk about that more later on. But to qualify, so there has to be certain qualifications for S corporation status. So this is where it's kind of different than a partnership, where partnerships you didn't have really a lot of requirements.
It just has to be more than one.
Yeah.
More than one partner.
Yeah. Interesting.
And the partner type could be all sorts of different types.
Yes, correct. Interestingly, S corporations, they can have only one owner, so that's one difference right there. But they have to meet the following requirements. So it has to be a domestic corporation, have only allowable shareholders. So there's only certain kinds of entities that can be owners of S corps. So individuals, certain trusts and estates. It cannot be like a partnership, cannot have ownership in an S corp. Corporations or non-resident alien shareholders cannot be owners of an S corp. You cannot have more than 100 shareholders of an S corp. So when you're thinking of trying to get a lot of investors for a company, S corporations is probably not the way to go if you want to have a ton of people to invest into your company because of that 100 shareholder limit. And you can only have one class of stock. And in order to be an S corp, you have to incorporate, and you have to file a form with the IRS that's called a 2553, and that has to be done by March 15th of the tax year that you want to start doing business as an S corp. So if you already have a C corp and then you want to have S corp status, then you need to file by March 15th of the tax year that you want to start being an S corp.
Yeah.
Or if you just start out and you want to just be an S corp from the get-go.
And you just start your business in June.
Yeah. So if you start your business after March 15th, you're not, don't think that, you've already messed up. Just file that 2553 within 2.5 months from when you start your business.
Got it. And one unique thing is you don't have to be a corporation and then elect S status. LLCs or other entities can elect to be treated as an S corp, right? So a partnership could change its status, file a 2553, and become treated as an S corp.
Yeah. You don't need to have a running C corp or anything like that. There's a lot of playing around with that, if you will.
Yeah, you could even be a disregarded entity, like a sole prop, and then change and elect to become treated as an S corp.
Mm-hmm.
So
Yeah, you just want to make sure, again, kind of going back, you want to make sure that whoever is owning the shares of that S corp is a correct allowable shareholder.
yeah, a key thing is no foreign. This is not meant to be a foreign entity in any way, shape, or form. It's got to be domestic. Okay, taxation of the income from an S corp, very similar to a partnership.
Yeah.
So, we've talked about Schedule K and Schedule K1.
Yep. S corps have that as well.
Exactly. So, eventually, if you're a S corp shareholder and owner, the ordinary income is gonna flow onto your Schedule E. Other items, interest, capital gains, will flow onto other areas of your 1040, just like a partnership will. The income is taxed at the owner level. So again, the S corporation does not pay entity level tax.
Most of the time.
Most of the time, yeah.
Again, there's
especially when you start to look at states, then there are different things that play in. But at a federal level, the S corp doesn't pay tax. It may be subject to penalties or something from time to time if you do things wrong. Anyway, and so the tax rates are the individual tax rates. 10, 12, 22, 24, 32, 35, or 37% are the rates that it can be taxed at, depending on where you fall. And this is where there's a little bit of a difference already. So from a partnership to an S corp is the income is allocated based on the ownership percentage, and that's it. Mm-hmm. There are no special allocations allowed because we go back to we can only have one class of stock. If there are different allocations applied, that's essentially implying there are separate classes of stock. Mm-hmm. So that's where that comes from. So you can't say, okay, this first return of income is going to be allocated to this shareholder because we wanted to get him in, and so we're going to give him that money.
Yeah.
And nope, it's just whatever the activity is allocated pro rata according to ownership percentage, and that's it, and that's all.
Yeah, and a little caveat as well, that also is for distributions as well.
Yes. Yep. Distributions, everything. So, another thing that's unsimilar from a partnership is the self-employment tax implications, right?
Yeah.
So, an active partnership, your income in that is going to be subject to self-employment tax.
Correct.
An S corp, it is not. All the income that flows through on the K1 is not subject to self-employment tax. And this is kind of the magic and where all the tax planning comes into why people elect an S corp, right?
Yeah, that's probably why you see a lot of people on social media say, make an LLC and then you don't have to pay self-employment tax or something like that.
Sure.
And this is kind of where it comes from, is because if you have an S corp, the income that you receive from an S corp is not subject to self-employment.
So if I am an S corp, do I just get out of self-employment tax? Is that what happens?
I mean, it sounds like it. No, the IRS isn't that, is aware of people, obviously.
Yeah, so that's not the way it works, right? The way it works is these S corp owners need to be paid a reasonable wage. Mm-hmm. And a little caveat here. So sometimes in a C corp, the reasonable wage, sometimes we're concerned with that reasonable wage being too high, or
there's like a limit.
There's like a limit. You're like, oh, we can't pay this owner that much money. That's not allowable. On the S corp side, so if you pay somebody a wage, that means you're filing payroll tax returns, right? And so if you pay the owner their salary, that's where you're going to pick up that self-employment tax. But it comes through on a W-2 like it would be for any regular employee at any company. Mm-hmm. So what we're fighting with there is it needs to be reasonable in the fact that it can't be too low. So if this owner is making $1 million a year, but they're taking home a wage of $40,000, and the distributions are $500,000. that's a problem.
Yeah, that's a big red flag for the IRS. And they're essentially, a lot of people are trying to skirt the line of they don't want to pay any self-employment tax at all or as little as possible, right? So they'll want to have their compensation amount as low as possible.
Exactly.
And so the IRS understands that. And so what they do, and sometimes they will audit S corps.
Yes, for this.
For this very purpose.
Yes.
And so you'll just want to make sure, and really for the reasonable comp, I mean, there's not like a set number, right?
There's not.
And that's what kind of makes it hard. And so you really have to do some sort of digging in detail. And some firms will offer this, where they do like a reasonable comp test, essentially. And
That's one of the things we do here at Larson. We can go through and do an analysis and talk with you about, and you dive into what are you actually doing specifically for the S Corp? And then you can compare it against market rates for somebody doing a similar job in a similar industry. Okay, and we ask you all these questions, and we come to and we say, okay, this is a reasonable number. And then we have this thing saved on file, and we update it as needed as your role changes or what happens. But if the IRS were to come and audit, and we hand them this report and this analysis of why your wage is what it is, they're probably going to say, okay, that's reasonable.
yeah, that makes sense.
It just needs to be a supported position.
Mm-hmm.
Sometimes people will get loosey goosey, and you can and they'll say, oh, well, we'll just say take a third of the net income, and that's your salary, or half, or something, and maybe that could be kind of right, but unless you actually do an analysis of what the reasonable wage should actually be, you're not totally going to be safe.
Mm-hmm.
So the next piece of income tax, is the net investment income tax. So we said, really, the net investment income tax and your investment in an S corp is only going to apply to those who are just holding shares in this S corp in an investment purpose.
Yeah.
So they're not actively participating in whatever it is this S corp does.
Yeah, it's essentially just an investment for them.
Yep.
Right?
Yep. And so, yeah, that's all that there is there. We've talked about net investment income tax before. Basically what it is an additional 3.8% on their share of the income from their investment. Mm-hmm. So, and then lastly, it does qualify for qualified business income deduction, again, which is basically summed up as 20% of the qualified business income you get to take as a deduction on your 1040.
Mm-hmm.
So you make $100,000 in your S corp, you're going to be able to deduct $20,000 of it as a deduction from taxable income on your 1040.
Yeah, which is really nice.
It is.
It's one of the big reasons why to have a flow-through entity.
It is, and
partnership.
Yeah, that was one of the big things with the TCJA.
Mm-hmm. So kind of going off of that, so we talked a lot about income. Let's go kind of more into the loss aspect. What if we have a loss?
Yeah.
And in order to talk about that, we really need to first talk about basis, which is everyone's favorite topic. Basis. We talked about basis within in the partnership episode, and it is a similar functionality with S corps as well, where your basis is essentially what represents your investment in this S corporation. And so your initial basis is measured by the amount that you paid for the stock or fair market value of services, net book value of assets that are contributed. And then every year it gets adjusted based on your contributions, your additions to your basis like income or tax exempt income, or subtractions to your basis like losses or non-deductible expenses, and also distributions. And that gets you your tax basis every single year. And the way that you can take losses is you can take losses up to your basis, and your basis cannot go below zero. So if you run out of basis, then those losses are suspended until you can get more basis in further years. So one thing to note that is different between S corps and partnerships in determining your basis is that partnerships, you can have, we talked about this, you can have the debt of the company can go into your basis.
Yes.
As a partner or as an owner of the partnership. On an S corp, however, there is no debt from the company that goes into your basis. So theoretically, if you have an identical S corp company and an identical partnership, your partnership basis will be bigger than your S corp basis, even if it has the same amount of cash, the same amount of debt, the same amount of activity, income and losses, and so on.
Yeah, if you have a mortgage on a building and one's in a partnership, one's in the S corp, that mortgage will get added into your basis on a partnership and not on an S corp.
Mm-hmm. Which is another reason why, and we talked about this in the partnership episode, a lot of real estate is owned in partnerships, not in S corps, just because none of the debt can go into your S corp basis. So that's pretty much it with losses and basis. And we kind of talked about a little bit already compensation of owners.
Yeah, and I don't think we need to go much more into that, but just again note that as a S corp owner, you do need to be paid a wage, whereas again in a partnership, you never do that. You don't pay the owners of a partnership wages.
Right.
It's against the rules. We're on a S corp, we do need to do that. That's where the self-employment tax piece is picked up, and
and you're filing a W-2. Let's
Yep.
just make that abundantly clear that for an S corp, the shareholders of an S corp will receive a W-2.
Yeah, and I guess one point to note on that is, so that's where maybe the compliance cost of having an S corp might be a little bit more than having a partnership, because this is going to necessitate that you file these payroll tax returns, and they're due quarterly and annually, and so there's a lot more things that have to be done and filed. You probably should employ somebody to help you, administer your payroll. And again, because payroll is something that you do not want to mess around with. It's one of those debts actually that can never go away.
You can't declare bankruptcy on payroll taxes. Or
Exactly.
anything like that.
Payroll tax. And so you don't want to mess it up, and the penalties will get high really, really fast, and payments have to be made, all along the way. So it's worth it to have somebody help you do your payroll.
Yeah. Not even, and that's and on the federal side and on the state side.
Yep.
And
Yep.
there's
and
also,
then it gets even worse if you're operating in multiple states, have employees in multiple states. Yeah. So the compliance can really go up once you have to have payroll involved in your entity. So something to consider.
Yeah.
If you're already running payroll in your partnership anyway, because you've got employees or whatever, then it's not a big deal to just add yourself into payroll when you switch to become an S corp. But
it's a lot harder the other way around if you're not.
Yep.
If you're not already doing it, and that's why a lot of people, when they have a sole prop and they're like, oh, should I make an S corp? And sometimes it can be beneficial, and others it's like, well, you have to have a whole other, because normally if you have a sole prop, it's just on your Schedule C. So
right.
then you have to have a whole other. First of all, you have to have a whole other form. So the 1120S is
So we're filing another tax return now.
Yep, we're filing another tax return, so
It's due a month earlier.
due a month earlier, and now you have to file payroll taxes and payroll reports. So
Yeah, so sometimes when we are talking with somebody about doing some tax planning, and they come to us with a sole prop, and they're like, okay, what can I do? What can I do to save money on taxes? One of the things we'll look at often is the S corp. We'll say, okay, should we look at making an S election? And we can say, okay, you paid whatever $15,000 in self-employment taxes this last year, and if you make an S election, you're only going to have to pay $7,000 in self-employment tax or whatever it is, because basically you're going to skip out on like half of it.
yeah, because you're not going to say that your salary is the total amount of income.
Exactly. So typically but then you have to say, okay, but I need to now file another tax return, plus I have to file all these payroll tax returns, and is my net savings going to be worth it? And we can do a little analysis there and estimate, and maybe it is, maybe it isn't, or maybe you say, okay, not yet, but once you start making a little bit more money, then it will be.
Yeah, sometimes you're just simply not making enough. Your business isn't to the point where it warrants having that S election.
Yeah.
So moving forward, let's just talk a little bit about contribution of assets. So we've kind of talked about how like the partnership, why a partnership has like a building, for instance, and why S corps do not. So the reason why is, or part of the reason why is because of this contribution of assets. So under an S corp, normally it's a non-taxable event only if it meets what's called Section 351 requirements. Now, what are those requirements? Its property is transferred to the corporation solely in exchange for stock, and the transferors have 80% control of the corporation immediately after the exchange. So that's the requirement for Section 351. If this Section 351 requirements are met, it's a non-taxable event, and your basis is a carryover basis. So let's say you're putting in a vehicle, and it's in exchange for stock. You have 80%, at least 80% control of the corporation immediately after the exchange, and you purchase the vehicle for $50,000. Then your carryover basis is $50,000. However, if it's not met, this Section 351 is not met, gain or loss is recognized by that shareholder, because essentially you're selling the asset to the S corp.
Treating it as a sale.
Which can get kind of dicey. And if you're treating it as a sale, then you pick up that income on your 1040, and then also, I mean, I guess what would be the nice thing is you get like a step up in basis or whatever. So like your basis, the basis of that asset in the S corp has now gone up to whatever. So if
you've missed your chance to defer any gain at that point, essentially, right? Like we talk about taxing unrealized gains, right? Essentially, you've gone and forced yourself to tax your unrealized gain when in that scenario. And that's where, so it's kind of the same thing on the flip side. If you're trying to take property out of an S corp, you can't just distribute it. It actually has to be, it's treated as a sale. And so if there is a property with a gain, then you're going to have to realize that gain at the entity level when it's distributed.
Yeah. It's so contributing and distributing assets in an S corp is not the funnest.
Yep.
I mean, if you're keeping it with like so how can you essentially get around this, right? First of all, just contribute cash.
Yep.
Because cash, the fair market value of cash is always going to be the same, so it doesn't matter. And then purchase the assets like from the S corp position, right? So have the S corp purchase that truck or whatever that you have.
Yeah.
And so
you probably, what you don't really want to hold a lot of appreciating property in the S corp is what it comes down to. So your equipment, operating equipment, vehicles and things, those are all depreciating assets. Real property and buildings and stuff like that, you probably don't want to hold in the S corp. Hold that in a related entity and pay rent or whatever you have to do to deal with that real property that's associated with your business.
Kind of a tax tip or whatever that I've seen a lot of people do is they'll create a partnership that essentially is just a holding partnership for all of the property that they have.
Yep.
And then they have the S corp, which is the S corp that they actually like work in. So essentially the partnership is like just a property management, essentially, where they're just managing the property, and all the activity in that is just taking in rent from the S corp, and its expenses are just like property upkeep, the mortgage and interest and things like that. And everything else is done under the S corp name.
Exactly.
And all the employees are under the S corp name of your business and all of that. So you have, and we kind of talked about this a little bit with the partner episode with Craig about, you can't pay a partner a W-2. So, what do you do, right? And you can create like an S corp, I've seen.
Yes.
But the thing is that the S corp has to be legitimate. It's the
it can't just be a holding company.
Yeah, exactly. Yeah. Like the purpose of the S corp isn't just to have only payroll activity in it, right?
Yep.
And so you want to run all of the income, the deductions and everything through that S corp, and the business essentially is running. The business is the S corp, and the partnership really is only just to hold the buildings, right?
Exactly.
So that's just a little.
Yeah, there's a little tax tip, a little tax planning there. Yeah, something you'll see in ways to, just because you elect to have an S corp doesn't mean now you're excluding yourself from operating in this business area because of I don't want to hold property in an S corp. Mm-hmm. No, it doesn't mean you can't you can't, you have to
Own
exclude yourself.
property.
You need to structure it appropriately so that you don't put yourself in a bad situation.
Yeah. Yeah.
Okay, so to wrap up, a little pros and cons for the S corporation. First pro, single level of taxation, right? No double taxation like you get in a C corp. It all flows through to the ultimate shareholder and is taxed there. One of the cons, restriction on the number and types of the shareholders, right? So not a good investment vehicle. If you're a startup and you're looking to exit in a couple of years, and bring in investors and different series and rounds of raising capital, S corp is not for you.
Yeah. Don't even look into it.
Yep, don't do it. There are much better options. And so along with that, if you are an S corp and you don't do it correctly, all of a sudden your S status could be revoked.
Yeah.
And what happens if your S status is revoked, Spencer?
You cannot reelect that S election for 5 years.
So there's that, but also
You're now a C corp.
exactly that's what I was getting at. So now you're a C corp. Now your distributions are now taxable dividends, and
And you have an 1120 that has its own laws and regulations. You have to.
I mean the 1120 is paying tax now.
Yeah,
It's
so
paying
now you have-
21%
Yep.
on all of its income.
You don't have QBI anymore.
Yeah, so
There's no-
you've blown up all the benefits that you thought you had are now gone, and you're getting hammered with tax consequences.
Yeah, and hopefully you know when you're doing this termination event, because if you don't, then the IRS can come back and say this is the date of termination, and we're going to go back, assess penalties and interest and all that stuff.
Exactly.
Yeah, I was gonna jump in and just say you can optionally revoke your S election as well.
Yes.
If you create an example you guys said, if you're looking to get out and you create an S corp and you're kind of like, shoot, this doesn't really fit my future plans, you can optionally revoke it as well. But
Yes, you can.
what you want to avoid is the IRS coming in and taking it from you forcibly.
Yes.
Yeah, you don't want to. But it's called a termination event essentially, and so you don't want to have a termination event.
Yeah, a common thing it's not common, but a thing that might mess people up is the unequal distributions.
Yes.
So that's kind of where that's a thing that we are constantly
We
working
see this
with.
all the time.
Yeah, in our small businesses, right?
Yeah.
An S corp, S is kind of like small business, right? It's
A
kinda-
small corporation.
Exactly. That's what you're thinking of there. And so sometimes the bookkeeping isn't done to a good enough level, it's
Yeah.
or just whatever, or somebody, they just make a mistake.
Yeah,
They're
or
just
they
like-
or they might not even know. Like whenever they're setting up an S election, like the S corp, and they were doing the 2553, whoever did it, maybe they did it on their own. They could have. It's possible, or whoever was
Sure.
helping them just didn't mention the fact that no unequal distributions. It's not something that I would think is. I mean, and in the obviously being in this for years now, it's not common knowledge for a lot of owners.
Yeah, you're right.
For a lot of owners to think
They don't really
about.
understand that.
Yeah.
And so then they're like, yeah, well, okay, I'm just gonna give my partner. He's not really a partner. My other shareholder in this business. Yeah, he's gonna take the truck, whatever, out of the business, and that's fine. And you're like, oh, wait, that's a problem. We can't do that. And so it's just something that you gotta watch out for.
You'll just see. They'll just write distribution checks throughout the year
Yep.
at a whim or something, and then at the end of the year,
Yeah.
like, hey, these don't add up correctly to your correct ownership percentages. So
Yeah.
you either need to pay it back or you need to write a check for X amount to these shareholders to make it right.
Yeah.
Yep. You got to fix it. It's got to
Yeah.
be right.
And if you're like, well, what the heck? Now I do a lot of the work, and the other shareholder doesn't do a ton of work, but you're saying that I have to distribute the same amount of cash. Well, now let's look at W-2. Let's look at payroll, right?
Yes, that's the way to take your fair share, whatever. But that's the way
Your
that
reasonable compensation.
That's the way that you can get your value out versus because you're the one that's actively doing all the stuff. So you can say, okay, we're going to pay me more money, but it's running through your W-2 at that point. It's not a distribution, so there are tax consequences associated with that.
Yeah, not everyone has to be paid the same salary.
Correct.
It's just so again, there's the difference. Distributions are different than like a salary. Right?
Yes.
So yeah.
Yep. So again, all income and expenses are borne by all the shareholders according to their ownership percentage, instead of whatever special allocation you want to do. You get the QBI deduction, but one of the downsides is so new S corp owners, when they buy in, they don't get that basis step up when they join like a partnership does. And then the Section 754 adjustment does not apply to new S corp owners.
Mm-hmm. And you're probably thinking, well, what the heck is that?
Yeah, sorry, that's but
Maybe we'll do an episode on that.
we probably will. I'm sure we will. So
It's just something to think about, though.
S corps really shouldn't be viewed as investment vehicles for the most part. They're operating companies. You know, if you're going to start a dog grooming business, there's a chance that it should be an S corp.
Yeah.
You know? But if you're going to start
An investment holding.
an investment holding company where you're going to invest in a bunch of rental properties or whatever, and you're going to bring in 500 partners and all the, to just be capital investment, this is not the spot for you.
Mm-hmm. Yeah. Yeah. And that's pretty much all the pros and cons, just at a higher level. Some of the things that while coming up with topics for this episode, there's things that we didn't even touch, like how does fringe benefits work? Distributions of cash, like it has to go through AAA, E&P basis.
Yes.
Could be capital gain. Distributions of property. So we kind of talked about you don't want to do that, but in the case that you do that, and then you have appreciated property, how is that essentially handled? What are all of the S election termination events? Because just the number and types of shareholders isn't the only thing. What happens? There is shareholder debt.
You can have debt basis, but it doesn't, like we said, it doesn't work the same way that it does in a partnership.
Yeah. So what can you do with shareholder debt? And then we briefly for 2 seconds talked about AAA.
Yeah, accumulated adjustments account.
What is AAA? Like what makes up that account? So there's a couple of things that we didn't even mention in here where it would go. We would go deeper into that.
Yeah, we could almost do an episode on any one of these topics, and we probably will as we continue down the tax trail.
Mm-hmm. But just as we're wrapping up, if any of those future topic episodes, if you want that faster than another thing, if you want that sooner, feel free to reach out to us and let us know. If there's something that we didn't cover in S Corps that you heard about, please feel free to reach out. And even if it's not just about S Corps, really just anything, partnerships. Whatever. We're going to be coming up with our C Corp episode next month as well, so we're excited about that.
Yeah, and this is a good time of year to reach out to us, though, too. So
yeah,
November, December.
Yeah,
I'll never have more time to schedule episodes than in these 2 months.
That's right.
Awesome. Well, if you made it this far, thank you so much for listening.
See you out there.
Thanks, everyone. For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.